After a period of calmness, volatility spiked. And now, fellow investors, it is the time to ask ourselves whether this volatility is here to stay or it will come again like it did the past few times when it had spiked. We'll discuss the market situation, the calmness before this storm, the expectation that it will come back, stock market volatility, bond market volatility, which might be the crucial factor in this current financial conundrum, and then also to conclude with structural market impacts and investment positioning. But let's start with the S&P 500 that had the best week in a long time, 8% up. When you eliminate the previous week, everything looks great again. And if we look at volatility, it still remained high. We have had calmness, then a little bit the bear market recession fears here, of course the pandemic, but pretty much since the repercussions of the great financial crisis, we have had very calm financial markets. And what happened back here? There was the great financial crisis. Now we have this spike in volatility. Will it transition into a crisis or not? That is something we cannot know. But if I go to the Reserve Bank of Australia, for a change, the global financial crisis there is clearly explained, and the main causes of the great financial crisis: excessive risk-taking in a favorable macroeconomic environment, increased borrowing by banks and investors, regulation and policy errors, and then house prices fell, borrowers missed repayments, led to stress in financial systems, spillovers, failure of financial firms, panic in financial markets. That is the standard of how a crisis develops. We are here at a start, and then we can see whether it will develop in a crisis or it will calm down again. So first is positive macroeconomic and financial environment. Well, if we look at the high yield US index, before the great financial crisis, interest rates were around 7.58. Over the last decade, or in the 2010s, interest rates were even better, thus very positive financial environment, 6%. Then those spiked for a while and then returned a little bit lower, now spiking again. However, we are still living into repercussions of this very positive decade. Low interest rates led to the following. Since the great financial crisis, what did corporations do? Well, their financial leverage doubled over the last 15 years. If we look at governments, government took the excessive leverage that companies had and then quadrupled their leverage, because gross debt to GDP went from 62% for the US government to 121%. So that's a 2x. GDP was also 2x, thus 4x debt increase. And you can see here gross domestic product. So corporations had them in line, government debt spiked to X. And the solution to the last debt crisis, in this case, was more debt for governments. And there is this long-term debt cycle that Ray Dalio is warning us, and many others, how the path is not sustainable. We'll touch more on that, but let's dig into the stock market. A nice correction over the last month and a half. And nothing wrong with that if you look at it from a helicopter perspective. That is normal for stocks. However, when it comes to stock market returns, I think there is still a lot of delusion. First, everyone thinks stocks give 10%. That is correct on a P ratio, average P ratio of 15. On a P ratio of 10, stocks actually give 15% per year. On a P ratio of 20, stocks give 5% per year. On a P ratio of 30, stocks give you 60% declines likely in the next decades. Crisis and things like that. And that is what people forget when it comes to investing in stocks. Plus, if we look at volatility, there is much more sensitivity when the P ratios are 30 rather than 10. A P ratio from 30 can drop to 10. A P ratio from 10, it's unlikely that it will ever drop to 3.3. which is both a 66% decline. When the P ratio is at 10, maybe it can go a little bit lower, but there is not much of a drop long term. When the P ratio is 30, usually it dropped extremely and led to extreme stock price declines. That is because the market has been priced for perfection. Let's just take a look at Apple. The P ratio now is 30. The P ratio before the stock crashed 26%. The P ratio a month and a half ago was 40, which was insanely ridiculous, but Apple intelligence and all those things had to push earnings even higher. And still, I think the P ratio for a company that makes 95% of its products in China is a little bit crazy here. Still 30. Thus, in my opinion, the stock market is in huge denial, because when you look at projections, those projections are still for 30% S&P 500 earnings growth going forward, for those margins to still remain at extremely historical elevated levels, the profit margins of the S&P 500. Thus, I would call the stock market to be still, despite what has happened in the last month, in risk denial. And the denial is especially shown here, where stocks rebound 8% in a week like nothing has happened. The next issue, except for expensive stock markets, is debt. Perhaps even the core issue. As Ray Dalio says, we are in end innings of a long-term debt cycle, and then we have had stocks go down, flight to safety in treasuries, and then suddenly this reverted and people started escaping treasuries, and the 10-year treasury yield spiked to higher levels than early expected. And then it went up and down, so there is a lot of treasury volatility as people are looking for answers and stability in that market, which might even be more important. But the true thing is that interest, as interest rates went up, started to bite. Interest payments are biting, and this is US government current interest expenditures. From 500 billion, we are up to 1.1 trillion. And if you look at the percentage of spending, we are now at 14% of spending here, which means that the government needs to borrow each year to pay for interest, which is usually defined as a Ponzi scheme. So 2020, check the difference, and you can see here how interest starts to bite. Net interest spending in 2020 was just 382 billion. Now we are at 952 billion and perhaps even surpassing 1 trillion going forward. Interest rates, if you look at the long-term trend, the last 40-50 years of the 10-year treasury, interest rates went nothing but down. Of course, government levered, and now you can see here the trend, interest rates have started rising. If you have 120% of your GDP levered, then when interest rates go from an average of 2.5 to an average of 4.5, that really shakes the financial stability in the system. And you can see here that really the governments enjoyed 2% interest rates for more than a decade here over the 2010s, and now that has changed, and especially the repercussions are seen here, where over the last 10 days interest rates spiked with huge jumps here because the markets have started to be concerned about this. The markets are like chimpanzees, so they can think 2 seconds about something, then they switch to something else. Now they have showed concerns about US treasuries. That is something that has been discussed already many times. Many great investors and minds have warned us about it, but it takes time for the market to grasp that. And then the market always short term, what are other people thinking, and then moving according in that way. And we'll see later the Wall Street perspective, which is idiotic. But here we are now. The forecast is still for deficits, borrowing to sustain the situation. And the truth is that we are on an unsustainable fiscal path. And it's not just me saying that.
In the long run, the U.S. is on an unsustainable fiscal path. The U.S. federal government's on an unsustainable fiscal path. And that just means that the debt is growing faster than the economy. We're borrowing from future generations. Priority on fiscal sustainability. And sooner is better than later.
Thanks, Jerome. Further, everyone expects rate cuts. And yes, if interest rates go lower, things get better. But sometimes the markets are not just happy to have rigged rate cuts and then they push interest rates higher, volatility is spiking, and we have the following issues. Debts are piling, Ponzi scheme unsustainable. We have historically high valuations, we have rising interest rates, and we have very negative demographics and slow growth in developed economies. And yes, on top of that, you can add tariffs, US, China, things like that. But the first factors are the key factors. So the key risk going forward might be a failed treasury auction. US, Germany, France, who knows? And that is something that we have discussed when looking at Druckenmiller, when listening to Paul Tudor Jones. They were all short the long-term US bonds, and they were completely right on that. Further, if we look at the great financial crisis, there was the housing market. Now I'm going to remain with private equity. And we discussed this, how it is in a bubble, and I just go to Brookfield's page and I look at this, and they constantly acquire something new. Now they have acquired Colonial Enterprises, so they put 500 million of their equity investment, and everything else is sourced to Morgan Stanley, Mizuno, Morgan Stanley, senior funding, things like that. And then they buy 9 billion of assets for that. 9 billion, okay, but the key thing here is Brookfield is buying in an auction process. There were 5 interest customers, and then who pays more? And they are saying, oh, we won, we bought it. But you paid the highest crazy price. That is not investing, that is gambling on over the last 15 years, positive macroeconomic and fiscal financial situations. Everybody has money. Let's go for the fees, the investment bank, and they are proud that they paid the highest price. That's something that doesn't work forever. And when this reverts, they are not able to pay the 8.5 billion of debt on the 9 billion of payment that they made with just 500 million in equity. If that goes wrong, you have that reversal, and then you have the repercussions that we had in 2009. Same story, just a different place to play now. And the solution, everyone expects the Fed to intervene. That's the miracle. The Fed will lower rates and will again have a boom, because the markets are wired on that, because that is what has happened in the last 20-something, 30 years. The Fed would lower rates, print money, stocks up, everybody happy. But as Ray Dalio, watch this Ray Dalio video, says, we are at the long-term side of the debt cycle, and at some point the Fed cannot lower rates anymore. When it is so low, and even if it lowers, it has no impact, then the long-term debt cycle is done. We know it is unsustainable. We have discussed Spitznagel saying how we are not yet there. We can still see a rally on positive news, but at some point that cycle will have to revert, and then is when we are looking at 80% real, adjusted for inflation, negative returns. And if you look at the market, here it was down 50%, the Fed intervened, here it was down, the Fed intervened, then it wasn't really catching up, the Fed started printing money. The Fed started printing money before the pandemic, and then even more. Here, announcing AI changed the situation here, because stocks need to always go up. And let me just show you how crazy Wall Street is. This is from yesterday from Bloomberg. Bank of America's strategist investors should sell any rallies in the S&P 500. They should go into the 2-year treasury and short the S&P 500 to 4,800 points. This is insane. So 6 months ago, you were predicting the stock market to go to 6,600 points, 10% up. And now when stocks prices are lower, you're telling your clients to sell. This is idiotic. So volatility, is it here to stay? Hard to predict. We know we are on an unsustainable path, but we cannot know when that path will change its course. So all we can do as investors is stay true to the fundamentals, position ourselves so that no matter what happens, we do well. Nothing is linear, nothing goes like this, except the stock market, of course. But our portfolios have to go up like this and then don't go down like this when the stock market reverts. That's it.